This is the Mobile Home Park Lawyer Podcast with Ferd Neiman. If you're looking to generate wealth and passive income in the lucrative world of mobile home parks, you're in the right place. You'll discover solutions to the common legal and operational pitfalls and how to optimize parks to maximize income. Your host is in the trenches. He's a real estate attorney, financial analyst, and mobile home park investor and operator. Now, let's turn it over to Ferd Neiman.
Welcome back, Mobile Home Park Nation. Ferd Neiman here again today with another episode of the Mobile Home Park Lawyer Podcast. Got a great guest for you today. Interested to hear her input on the market. It's December 5th as we record this, so lots of turmoil in the banking markets. She's a loan consultant, helps originate loans from a number of lenders. She works with Eastern Union. Please help me welcome my guest, Emma Norman.
Hi, Ferd and audience. Thanks for joining us. I really appreciate it. Ferd and I made a connection instantly over LinkedIn, pretty fast, and then we started seeing each other back and forth at various conferences. I do specialize in mobile home park loans. That's my jam. When I started 3 years ago, I came in with a concept that was going to be my full focus. And so here we are. I've had the tremendous luck of getting fantastic mentorship through Eastern Union, as well as my clients, as well as partners as well. So I'm very happy to be here. Let's put it that way.
Well, great. Well, thanks for joining. So to maybe give us some insights of what are you guys seeing in today's market and what are the typical rates look like in terms, and I know we've talked offline about, you know, the new hurdles, so to speak, to get to approval with different loan lenders. So I'm curious, just get your insights on the market.
So right now, great news. The rates have dropped. We're looking at about anywhere from, there's been a 50 BIP drop in the mobile home park sector. It obviously depends on the asset itself, the sponsors, and what's going on with the lender themselves, as well as on a national level, how they're being affected there too. So one case that we're working on right now, when he first started back in, I want to say May, we did get him a great loan, agency loan at 7.4. Today, his rate has dropped to 6.5.
Wow, what size of loan is that?
So what agency lenders really like, or approved lenders rather, is at least at the 2 million mark, and he made that mark. So that's where they like to start. I know a lot of the talk about all of us brokers and all owners and things of that such is that you want to start at 1 million. In the case of agency, however, you do want to start at 2 million and up. Just to get you at the top of the stack.
Because my recollection on this, because I've done some agency loans less than 2 million. I think I've done one less than 2 million. So I know that the threshold's 1 million. I've even heard of them making exceptions to 750 in some limited instances, but they have a certain allocation. They got to get so many done, use it or lose it, so to speak, and they want to get them done by the end of the year. And they prefer the bigger ones, right? Because $2 million loan is half as much work as a $1 million loan in theory, and they get a knockout too. Now, end of the year, are you running into any trouble with lenders running out of allocations? Or because in the past, I know if you get one approved early in the year, they seem to be more favorable because they like knocking them out early, and then they can take vacation after Thanksgiving, so to speak.
That's 100% correct. We're all human here. We have our families that we've been, that we've had to fit out throughout the year, and they've reserved their family time for the end of the year. They would prefer to get those loans closed before the 21st, before the 28th. And that's just energy, right? That's not also including liquidity on their end. Just like Ferd had said, their buckets are running dry by the end of the year. And if you're looking to carry over, that doesn't necessarily mean they're willing to look at it.
Right. Exactly. Now that's specific for agency. For our listeners don't know, that's Fannie Mae and Freddie Mac. What about, local lenders and regional lenders you work with? I mean, they don't really have the same level of annual allocation, do they? They're more they look more at the borrower, look more at what their existing portfolio is, And then they're more concerned on some liquidity and deposits and things of that sort, right?
100%. First of all, it's great being on the podcast with you because you were on such a high level as far as that goes. And yes, that's exactly correct. With local lenders, they are going to look to buffer that time a little longer because the 2 week to 4 week with local community union, community banks, as well as credit unions, they're looking for that added due diligence side on their side as well. Like you as an investor, you want that extra time to make sure what you're going to invest in is actually a great asset, like the numbers say, right? So they are going to look for right now an end of January, mid-February closing. It's still a really great closing, because if you can get it closed 45 to 60 days, that's like fast track for CRE, commercial real estate, fast track. So when you're first getting into this commercial arena, that's one of the hardest things to understand, especially if you're coming from single family, for example, and or multifamily too. They do relatively quick closings. With mobile home parks, that simply isn't the case. The fact is, a lot of lenders do not understand mobile home parks whatsoever. So if you're pitching your deal to lenders who first off don't understand, and then you're trying to rush them, they're going to give you hard stops pretty quickly. So you have to be patient when you speak to that loan officer. And I hate to say it this way, but if you come in a position of, I'm getting a favor, that gets farther in the process.
What do you mean by that? But you're getting a favor?
Well, I understand that, as an investor myself, it is important that you meet these milestones and you meet the timeline, because you have to deal with all of the soft touches all around you. I get that. However, there is not a lot of MHP lenders, period. If we're per 100 I shop out, maybe 5 will say, okay, we'll take a look at it, and then maybe we can push them around for like 2 or 3 term sheets. So when I say look at it as they're doing me a favor, I'm not saying kowtow or anything, because you can't, right? This is your investment. You just can't afford that. I'm just saying be likable and you'll get farther.
Okay, so in general, the process would be I would come to you and say, hey, I'm looking for a financing for this new acquisition or this new refinance. Let's assume it's a new acquisition. It's $2 million. I'm looking for a loan. I'm aiming for a 75% loan at $1.5 million. Maybe you could stomach a 70, probably can't stomach a 60 or 65. So what I come to you, and then when you say shop it, so then your process is you have lender relationships and you reach out to them and you request a term sheet. And then some of them say nothing and they don't respond. Some of them say thanks, but no thanks. And some of them say yes, and here's a term sheet, which has exceptions of, and outs for the lender. But basically, you then try to bring me several offers, if you will, from lenders. And then we begin to proceed down a path, typically with one of them, through underwriting, through a loan committee of some sort. And then ultimately, we would get a preliminary loan commitment approved with committee, and then eventually a final loan commitment, and then at closing, a funding of our loan. Is that pretty much the process?
That is pretty much the process, yes. I will describe some of the hiccups you can expect along the way. For example, it is very regionally based what the lender will come back to you with. It is not uncommon to get 80 to 75% LTV in the South. Not at all uncommon. However, it is a little uncommon for anything at 70 to 75 right now. You got a 50-50 split, Midwest. Okay.
What do you mean a 50-50 split? Meaning half the banks won't do it?
Yes.
So they want to do like 60 or 65 LTV.
No, they want to do 70.
Okay.
And then, yeah, that's for now, right now, for us at Eastern Union, that's a hard stop. We're not really looking to bring anyone back anything less than that, unless you are capable, of course, unless you're syndicating or you have a fund, an equity fund. then you've already dictated you wanted non-recourse and or any of those things. So what Ferd's example is a great example of someone who is expecting to have a recourse loan, which means you're going to guarantee, you and your partners are going to guarantee, everybody over 20% is going to guarantee. Okay. So in the Midwest, 70 to 75 is not a hard ask. Okay. When you get into, let's say, Wyoming and let's say Idaho, you're looking a little closer to 65.
Okay.
Okay. So that's maybe one of the hiccups. So let's say you have all of these standards that you expect to get back on your term sheet, not including closing date. Okay. And you come to me with all of those expectations, and then I will let you know, hey, in this market, that's not necessarily what I can come back with. You know, maybe you have other options and you can explore those options, which that's my job. I'm here to advise you on what's correct, what is actually happening in the market from my perspective. Okay. I always build in that you have a different perspective, and that's great. So that's one of the hiccups. I then go to evaluate via income approach. I only do income approach. I'm sorry, I will not do cap rates. I understand that as an investor, we do use cap rates, and I totally get that. However, a lender that's not going to play well for you, because when the appraiser comes in and gets their broker opinion, so on and so forth, I have noticed that the cap rates are never going to go the way the buyer wants it to go, the sponsor wants it to go. So I only use income approach.
And when
So
you use income, can I jump in? Because
yes,
in general, in valuation or appraisal, I'm going to take the income, the net operating income, divided by a cap rate. That's how I come up with my value or my price. So there's a cap rate in the formula. But when you say you're using income approach, does that mean you're sizing the loan based on the in-place income and a debt coverage ratio, say 1.25 debt coverage ratio, and then you back into the maximum loan proceeds?
yes, that's
Okay.
Exactly what I'm talking about.
That's how
articulating that.
Lenders often do that. I'm curious on differences from in today's market here in December of 23 versus say 6-12 months ago. How has that coverage ratio changed, and how has the lender made modifications, if you will, as it pertains to value vacant pads, which is 0 on an income approach? But then what about value of rent increases? Like, let's say the rents on this $2 million park are 300, but the market's 400. Is the lender going to size my loan based on the in-place 300, or are they going to give me somewhere between the 300 and the market 400?
So they just like you should do as an investor, they're not gonna value your upside.
Okay. So you're not getting any of them that'll even, because I've had loans where if the deal is thin based on, it's low occupancy, for example, and below market rents, I've had banks say, we'll give you a waiver of 1 year below the 1.25. Let's say it's 1.01, which is pretty thin, but then you have occupancy goals. And I've seen lenders sometimes be like, all right, we'll give you credit for a $30 rent increase, but we're not going to give you credit for 100. So so today you're saying that's not the case, but was that the case 6-12 months ago? And was it normal or rare, I guess?
Okay, so I'm gonna illustrate Ferd's perspective and things right now. He is a very strong sponsor. He's
Okay.
a very strong investor in the MHP.
No, don't stop. Keep going.
So
I wish my wife was here to hear all these nice things you're saying about me.
His numbers and his abilities with his lenders are going to be starkly different from a person who's just starting out. His position gives him a lot of leverage. I do have other clients that are in exactly Ferd's position. I am speaking to the audience who is at about 5 to 10 parks. These are their expectations. When you're above 10 to 20 parks, your equations do change. Lenders are willing to work with you longer. They're willing to work. And if you happen to be a darling who's been in the business for over 20 years, they're just willing to work with you a little bit longer. They're willing to give those waivers. And of course, that also is heavily built upon the relationships already built by the broker
Sure.
or by the client and the lender. So what you're saying is exactly true. For your position, that's exactly true. For a lot of people aren't quite in that position, and that's why it's so important to find those seasoned investors. Like I constantly say on Facebook, my Facebook group, and I constantly say wherever I can. That gives you the instant leverage in a conversation with another person in the arena and or lenders and brokers.
Okay,
It
so
just
good
made our
insights.
job easier.
Yeah, well, sure.
Yeah.
Some good insights there. So, follow-up question: do you typically attempt? You're not going to do this with agency lenders, I'm sure, but we're most likely sure. But on regional or local banks, if the property has some infill needs or some capex needs, are you able to push the lender to get some funding for like a line of credit for infill, which would be an alternative to say 21st Mortgage's cash program, and then a line of credit or construction loan for some capex, say repairing the roads for 100,000, which if approved would be a substitute for more post-closing equity. How is that a hard no for banks, or if it's your first deal, is it a hard no, and it's your 10th deal, is it a maybe? How's that go?
So I have had a deal in the past where we did do a line of credit for a person who just had one park. The asset itself proved to be very valuable in that sense. He had it for about 5 years and it just made sense. So just to describe what sort of investors, lenders really like, and to be able to give you that extra money for infill and capex, experience. They really, I'm sure you've heard this over and over again, they really like experience, whether that's measured in 20 years with 2 parks or it's measured with 20 parks in a year. They love both. Okay, those are their 2 darlings. Okay. And if you're in this sector, you're going to fall into one of those at some point in your career. So the possibility of you getting that second loan is for capex, for infills, is higher if you manage to separate the original contract from the homes and the lots. Okay, you make 2 different offers. That really helps you out. If I say to you as a broker, I'm sorry, on this particular deal, I can't get you that loan, and you're able to pitch it to other lenders who can evaluate that and or maybe just give you that particular smaller percentage of what you're looking for. There's also earnouts where you would initially put up all of the funds to do your infills, your capex, and you go back and you show the lender your scope of work has been completed, and they will reimburse you. We do both. We do those angles all the time.
Interesting. So an earnout in that instance is I front the money, but when I deliver, let's say I put up 100,000 for road, then they'll finance me for the 100. I get my capital back. I can use it for something else.
Exactly.
Okay.
Exactly.
Yeah, we've had some success with lenders, not on the first loan typically, but where we, ideally. So what I tend to do and recommend to people is if you're going to a new bank, take them a deal that's kind of down the fairway that doesn't have as much hair on it, and build a relationship. And then you can later go back to that bank and say, hey, I got another deal. And they're like, great, we love working with you. And say, well, this one's different. This one I need some capex loans. I need a construction loan. This one I need a line of credit for the homes. And then the next tranche would be I need a set of revolving guidance loans where when I rent the homes, I can then put them on their own individual term out loans, say 7 or 10-year ammo. And that's been helpful for us. I haven't been able to get local banks to finance the end buyer. So that's where you've got your PEPs and your Triads and your Zippy and your 21st Mortgage to finance the end buyer.
Right.
So that's just kind of maybe a tip for people structurally. What percentage of banks are doing non-recourse loans? Any of them besides agency or CMBS?
So it's been tough on the ground as far as community banks and credit unions go. However, the lower your LTV, the higher your probability of getting non-recourse.
So a 50% loan is a maybe, a 75% loan is a heck no, basically.
Basically, yes,
Okay.
that's what you're.
What about liquidity requirements? I know, I feel like a year ago, I never even heard that term. Now it's like you make a loan request and they're like, well, we need to have deposits, not liquidity, I misspoke, deposit requirements. Where now I had a client recently, I don't remember the numbers, but it was something like $3 million loan. They had to put $1.5 million in checking
Whoa!
in checking, and they had to keep a minimum balance of $1 million for like 18 months. So I'm like, wait a second. So you're borrowing $1.5 million at 7.5 or 8.5%, and then you're going to turn around and lend it most of it back, or it was like 50%
To me,
back
exactly,
for almost
borrowing my own
nothing.
money.
So
Exactly.
I've seen that a lot, and I've also seen deals in the last 90 days. I've seen more deals die from the lender than I have in the last several years combined, where, in one deal in particular, the lender pulled the plug on my client the week of closing. And the stated reason was, we don't like that state because it has a high concentration of oil. And my client's like, it's been in the same state all along. You knew that 90 days and $75,000 of, costs ago. And
Right.
it was infuriating. In that case, the lender ended up later caving and say, okay, fine, we'll do 50% loan. So we had to go back to the seller for the other 20 or 25 and ask for a seller carry. And in this case, the lender allowed it, the seller agreed to it, and the seller had the wherewithal to do it because they didn't have much debt on the property to begin with. So it was kind of a perfect scenario, and it didn't even delay closing. It was like, we found out on a Monday, we're supposed to close on Friday. We still closed on Friday. Like, we got the, second mortgage teed up, and everybody agreed and updated the HUD and still got it done. But that was kind of a tumultuous, final 10-yard line, so to speak, for the client. So what are you seeing today versus a year ago as far as deposit requirements and or deals falling out based on lender discretion?
That deal did close, just to clarify. You did get it.
It did close.
Oh, okay.
Yeah,
Okay, that's good.
but I had two others, one from the same, we had three in like a week period. The three different clients, two of them were the same lender. One of those two closed. The third was a different lender that I had never heard of, and they just pulled the plug as well. And I've had several others where the bank will come back last minute and say, we're still in, but we need to lower the LTV 10%. And I'm selling a deal right now, and the buyer's got a loan, and I asked him, it was the same lender. I was like, you need to be careful. And he said, well, we're only doing 40% LTV because we have a bunch of equity in our fund. So that was a non-issue then. The bank's like, okay, well, if you're putting 60% down, no big deal.
Right. Well, that sounds like a great deal for you. Congratulations.
Yeah. So
Yes.
knock on wood, it hasn't closed yet. I don't count those chickens till they've
You
hatched.
don't count those,
I
right?
even get nervous. I sent my analyst something last night about, hey, start the email to investors, draft it for me. Where's the money going? Where's the proceeds? Here was the final return and yield, and we've got hurdles in there, and here's my share and your individual share, and here's where we're going to wire you the money. But I'm like, because you got to do some of that prep, because you don't be sitting on their money for a long time post closing. I'd like to send out the email, the day of or the morning after closing, but I'm like even nervous drawing it up, right now, because it's like, I don't want to jinx it.
Right.
Because
Right.
that's happened too. But so anyway, I'm rambling as is
No.
my discretion on my podcast. But I'll hand it over to you. What are you seeing in the market? What are you seeing in the marketplace?
So yes, a lot of the depository relationships are being requested. As a broker consultant, if it gets into parameters where it just doesn't make sense for our client, we just simply won't bring it back to you. So as a client, if you should be more specific because it is your deal. I should be more specific because I am your consultant. But for example, if we find the depository relationship just doesn't make sense for you, we most likely won't even convey it to you. So just do the simple process of saying why and make your consultants be specific That's very important for you to utilize this future data for your next acquisition as well. So yes, I would say in the market, wow, now that I really think about it, about 75% are asking for those type of relationships. Yes.
Wow.
Yes. And of
And-
course, that's highly dependent on the bank itself, whether they have the initial liquidity themselves, right? And that's part of our jobs as consultants and brokers, is to understand and know that part of the lender. Okay.
Yeah, I had dinner last week with, I'm in a real estate group, CCIM, here in Kansas City, and
You're in Kansas City?
I'm in Kansas City, yeah.
Oh no, I have another reason to go to Kansas City.
Yeah, well, thanks. Yeah. So anyway, there's like 9 of us on the board of this organization. So we had our annual meeting and dinner last week, and there are 4 bankers on the board, and we were asking each other. They were asking each other terms, and one of the banks said, "Well, I'm instructed right now to quote terms designed to not get any loans." And he's just like, "Yeah, they're like we're at like not.
Honest.
I don't remember the number, but he's like, yeah, we're at like 500 bips over SOFR," and the other bankers are like, "Is anybody taking that?" He goes, "No, none." But we're
I'm doing my job.
we're giving responses. The people are staying busy looking at deals. But yeah, we don't want to make any loans for the rest of the year. So we're just like, we're not saying no. We're just giving terms that make it look like we're active, but we're not. And I was like, wow. So I see that. And to me, the deposit relationship somewhat is like that, because at some point, if I commit to your bank to put X dollars in deposits, but then I want to get a new loan from somebody else's bank and they require 1.5x in deposits, at some point there's not enough X, in my liquidity. And it's like, I can't violate, especially if these have tails on them, where like you have to have an average balance, where it's like, I can show proof of funds that I got $100 in checking, but I got a requirement to keep $100 over there for the next 18 months. So I can't move $90 in checking to you. So I feel like at some point, the more restrictions, especially post closing, these banks put on us, the harder it's going to be to work with a new bank.
Right. Completely. They are all focused on their client relationships as it is right now. So it's just another, I hate to say it, but sometimes, just like we have our weasel clauses as investors, that's part of their deal as well. If you come in with the perspective of everybody's here to get, their best deal as well, and just don't take it personal, just move on and fast and hard as you can. Make sure to have at least two lenders in your background that you're always talking to on the same deal. Just caveats wherever you go, or if I'm using that correctly.
No, I agree. I mean, I have one lender in particular I do a lot of business with, but I've had to get other lenders because of caps at that bank. But then I've learned, like, okay, send the new lender the easier deals, which frustrates the main lender a little bit. But like, look, I got to get this one approved, and you can't participate this out, as easily. And so, yeah, just always having more than one lender relationship is important for sure.
It is. It really is.
Because that weasel clause you mentioned, I mean, here's the weasel clause that I've had a couple clients recently that the banks pulled the plug last minute, and they're of course fired up. They're like, can we sue them, or what recourse do we have against them? And I'm like, did you guys get, sometimes I'm not involved in their bank process. So I said, in this case, I said, did you guys get a loan commitment? Yes. I said, send it to me. And it says all big caps, preliminary loan commitment. And everyone's like, oh, see, it's right there. And I say, see how it says preliminary? Yeah. And I just go to the bottom, like page 4, and it says, this is a non-binding letter of intent or preliminary loan commitment subject to the bank's final underwriting, including appraisal, underwriting, and any other requirements the bank deems fit. This shall not be a binding loan commitment or a commitment to fund or lend unless you get a commitment to lend or a final binding loan commitment from lender. Right. And I look at the client and I'm like, that's all you need to know right there. That means you have nothing.
Yes, exactly.
They were flirting with you. And he's like, yeah, but in one of these banks is really infuriating because they made him put up a $50,000 deposit and they went and spent like $46,000 on third-party reports. Yes. Including they ordered zoning reports, even though we had done zoning as a law firm and had superior zoning letters and research on these cities. And it was a small portfolio, and this bank spent his money, and then the last minute says, we're out. And didn't give a reason. They won't, they don't have to. And I'm like, sorry, man, you just lost $46,000. And depending on the seller's willingness or underlying debt, seller finance may not even be an option here. Even if it was desirable to you, it may not be practically an option. And master lease and other strategies have their own hair on them. So if it's a new bank, I just say tread carefully and always have a second bank in your hip pocket if you can. Obviously, you can't get too far down the field. You're spending money and all this. But I had a client that was going down the field with with two banks. And they were spending money with two banks, and it ended up working out because the first bank bailed, or the first bank said yes, but then they dropped the LTV to like 50 or 60. So we already had a title commitment listing the lender, and we were ready to rock. And all of a sudden, the client sends the title company email. I didn't realize they were working a second bank. They didn't tell me, and they just say, substitute this bank, go with this bank. And I was just like, what? And
Nice.
And then they plugged in the second bank. And the deal ended up not closing, actually, ironically, for other reasons. So they ended up going over two. But it was a unique strategy that they were working two banks at once. And I was like, and they didn't even tell the first bank. Like the first bank would be pissed, but they're like, yeah, but the first bank
Backed out anyway.
Treated us, so
yeah,
it goes both ways.
Right. It definitely does. That's just the nature of this business. I hate to put it any other way, but it is the nature.
So what other tips can you give our borrowers, to get themselves in a position? Obviously, having great income, great net worth, and perfect financials is the easy part. But like, other than that, what can you do to stand out or improve your chances of not being left at the altar by the lender?
Right. So one of which would be, and I say this a lot, responsiveness. They are going to be your future partner. You're trying to make them your future partner by having them invest in you all that money. So treat them as such. Responsiveness is everything. When they give direction, what would really streamline your process is to make sure as best as you can without giving up your hand to deliver those goods. Okay. If you're getting closer to closing, know that, and you've decided on that one lender, you have to go 110% to get that to the closing line, a closing finish line. Okay. So responsiveness is number one, 100%. Number two is, please do expect to keep all of the paperwork that you've been submitting over the process of closing to be updated. It needs to be, their rent rolls and their P&Ls do need to be updated. Expect that request and have it handy. Do have a clear idea and understanding of your CapEx versus your repairs and maintenance. Be able to articulate that through your P&Ls as well as in conversation. That way you can get that cost basis back, some of those costs back, and it will just solidify your loan at the terms they've already agreed upon. It will not necessarily merit more loan proceeds. So again, be willing to let that go. So the less emotion you get involved in any of this process, the more likely you are to end up with the money. That's my second point. My third point is, you want to be at the top of that stack, bring in heavy hitters with you, and or at least reasonably seasoned investors with you who understand how to talk to underwriters, who understand how to talk to lenders and brokers, investment sales and or mortgage brokers. That will get you to the top of the stack as well. Understand your market. Really, truly understand your market. That way, any angle they throw at you, because you understand your market, you will have something to pitch back. You have to have that great defense, right? If they're trying to tell you, oh, there's no future population or influx of population, but you have a person on the ground that through your due diligence, they're inviting a Forbes 200 company or Forbes 500 company, and that's going to make all the difference, and that's underground. You have to be able to pitch that. Okay. So you need somebody like that on your team that would get you to the top.
Yeah, those are good points. One thing I'd like to add too, that we've done a pretty good job on is just, I say, be organized and then have your ducks in a row. So beyond just responsiveness, when we make a loan request, we try to make it where the bank says, that's everything I needed. Thank you. And that's kind of nice for once, you know.
Right.
I wish all my clients were like that. If you can get that sort of response, you're winning. So
Yeah.
what does that mean? So we'll send us a loan request and say, you know, dear lender, please see the attached loan request. And we've learned we just ask for a loan. We say, here's our terms. We don't just say, what will you give me? We say, here's what we want. And we'll have a little wiggle room in there. We'll ask for 80 LTV. No one, it's easier for them to say 75 now than if we ask for nothing. And then they're looking at 65, 70, 75. So we'll ask for 80. We ask for the line of credit. We ask for the guidance loans. We ask for the construction loan. And we say, here's the source of funds that we anticipate, including equity by the general partners. Here's the guarantors. Here's the use of funds. Here's a CapEx budget. Here's a profit and loss and a discounted cash flow analysis with certain hypotheticals and assumptions. Here's the business plan. Here's the market. Here's what we're going to do. Here's the LLCs and the operating agreement, the articles of organization, the EIN.
Yes.
Here is the resume and the personal financial statement and the schedule of real estate owned from the key principals. We have all this ready to go. And you know, and we'll as part of the business plan, we'll reference there's a new Home Depot 2 blocks away. There's a, you know, there's the university is expanding, you know, whatever the stats are that's favorable. Here's our infill plan, as you'll see set out in our profit and loss. If we hand that all to the bank, it makes it easy for the analyst to get it prepped for committee. I've had lenders even say, like, I just forwarded your stuff and that was my committee report, you know, like they instead of them having to put it all together. Well, then you get speed as well, and speed, you know, it's one of the variables involved in a deal. So if I can tell the seller that I can have a 30-day DD and a 30-day close instead of a 60 and a 45, and if I can say no financing contingency, well, that gets me the top of the heap. Well, then I'm have a lower price to seller, which makes it easier. And, you know, you mentioned earlier, like things to give to the bank. I want to make sure my PSA has a requirement that the seller must provide me a updated T12 each month, updated rent roll each month, so that I can give it to the lender. And then if you can do those sort of things, it just makes it easier to get to the top of the heap and get a fast approval. And, you know, that's been part of our methodology, and it's worked out fairly well.
It is tough, right?
If I get a quick no, you know, I've been told no before, right? If I get a quick no, I still have time. It's when like some of these clients I talked about recently, they got a $46,000 later no. That's hard to overcome. One, you just spent $46,000, you know, but two, you've spent time, you've got deal fatigue on your end, deal fatigue on the seller. You know, sellers often don't operate at 100% once they're in escrow. They just coast.
They do. They're looking for that check before it's, you know, before it's earned.
Yeah, we had a part, the closing got delayed like 3 weeks, and we had not inspected it in the last 3 weeks, and we probably should have, right? We show up on the day of closing with a whole crew of guys ready to do all this work. And then we find out the third-party mowing company didn't show up in August.
Oh, no.
And then the grass was 4 weeks tall. And there's like 80 vacant lots. So there's grass everywhere. And we look at the manager who we were going to retain, and we said, what the heck is going on? It didn't look like this the last 3 times I visited. She said, well, as soon as you guys let your inspection period waive and we're proceeding to close, he told me to spend $0. I fired the mowing guy. We didn't demo that house that was scheduled. We didn't cut down that tree that apparently is falling on a house. We just are spending $0. So it's your problem. So I'm like, okay, lesson learned.
Right.
You know, and the contract had some provision about they were supposed to continue to maintain and operate.
Right.
But not mowing the grass wasn't going to warrant terminating the contract and walking away or putting them in breach. It
Not
just
at
was
all.
like, had I known that, we would have. So then we call the mowing guy and he goes, oh, I got a day job. I can't come till Saturday. Well, it's like Tuesday. We look bad with the new residents.
Yeah.
So we went out to go and buy a lawnmower, fire the mowing guy, buy a lawnmower and get somebody to mow it the next 3 days to get it caught up, just to not look like slumlords.
It is really hard when you're doing both sides, and in your case, all sides, it sounds like. And it's hard to keep your back office organized. When you're busy in the dirt, literally under the homes, allocating all the meters and so on and so forth, it is really tough to keep your back office straight. If you can find a team that will always keep that front and center, you will have higher probabilities there, right? So the makeup of your partnership and the makeup of your venture in any shape or form must include someone who truly understands that side of the business and is able to work on it at impulse whenever called upon. That relates directly to what Ferd's point is speed. So making sure you have that back office, which is tough. Because, for example, there's a lot of park owners who have had over 200 sites for a few years, and it's been humming along with the processes they already have, and they got it seller financing. Okay, all of a sudden there's this lender who's very, very on point, very particular about how everything has to be presented to them so they can get it through the committee, and it's kind of off-putting in a way, because you still have to get those demos done, you still have to get those doors ordered, you got to get those Metron meters in, you got to make sure that you get your bill backs and your recapture rate, because the paper has to look good for your optimal loan proceeds. These are all things that you're gonna have to learn how to negotiate as you go along, and the better you get at it, the more revealing it will be to your partners, your investors, as well as your lender. So yes, these are all things you're handling as well. Everybody is.
Yeah, good points. Any other tips or advice before we jump, Emma, and then also where can people find you?
Tips and advice, I guess I start at $1 million and up. Sorry. Unless I've known you for a couple of years, then we can talk. As far as
that's your fee, that's your commission. You're more expensive than me.
No,
$1 million loan size.
The asset I meant the loan proceeds. Eastern Union is 1%. That is the market rate at where you go along. Advice: always surround yourself with people who are dramatically smarter than you, and you'll go a long way. That's the best advice ever. And then I got new stuff coming up, if that's okay, if I plug right here.
Sure.
Okay. My sister and I are starting a very informal podcast, not necessarily as honed in as like Ferd's podcast or any number of very great podcasts. And we're just sitting around and we're just going to chit chat and get to know each other for networking. Also do expect a newsletter of some kind in the next couple of months as well. Yep. And it'll probably be under the Facebook banner of MHP Investors Network.
All right. Sounds good.
All right. Oh, and I'm going to be at Louisville. Are you going to Louisville?
I am registered, so I'm currently planning on going. I'm not getting a booth because I'm not sure if I'm going to be able to make it or not, but I'm currently planning on going with Michelle in my office. And then, so right now the two of us are going, but I don't know about others right now.
Okay. We're definitely going. We love that show. If you haven't been, definitely go. There's a lot of great networking opportunities. There's the great thing about this sector is everybody's so willing to help you. Definitely get some space with whomever you can so you can have conversations like this. Okay.
All right. All right. Thanks, Emma. Appreciate it.
Thank you.
You've been listening to the Mobile Home Park Lawyer Podcast with Ferd Neiman. Ready to learn more? Go to www.themobilehomelawyer.com for free resources and materials to help you succeed. If you love the podcast, go to Apple Podcasts, give us your review, and subscribe today. Thank you for listening. Neither the Supreme Court of Missouri nor the Missouri Bar reviews nor approves certifying organizations or specialist designations. The choice of a lawyer is an important decision and should not be based solely upon advertisements.